Hey there, future CPAs. Welcome to this explainer. If you're a Gen Z BSA student staring down the barrel of the LXBA in a couple of years, you are in exactly the right place. We are not just going to mindlessly memorize tax rates today. No way. We're actually going to hack your long-term memory. We're tackling special percentage taxes under the Philippine Tax Code, specifically NIRC sections 119 to 124. By using cognitive chunking, we're going to plant this information so deep into your brain that 3 years from now, when you're sitting in that board exam room, retrieving it will be completely automatic. Okay, let's dive into this. To bypass that boring rote memorization, we're organizing these seemingly random tax sections into 3 distinct, easy-to-remember buckets: utilities and communications, banks and finance, which is where the GRT lives, and life and foreign insurance. And to top it all off, we'll wrap up with a cheat sheet of high-yield LCPA hacks. All right, bucket number 1, utilities and communications, anchoring your brain for sections 119 and 120. Go ahead and open up that first folder in your mental map. Under section 119, the franchise tax, there is a very hard dividing line. Gas and water utilities are taxed at a straight 2% of their gross sales. Simple enough, right? But radio and television broadcasting companies sit at a slightly higher 3%. And pay super close attention to the condition for that 3% rate. Their preceding year's gross sales absolutely must not exceed 10 million pesos. Listen, examiners love to test that 10 million threshold. If those sales jump over 10 million, or if they just choose to register for VAT, they are out of the percentage tax zone entirely and into VAT territory. So lock that 10 million ceiling into your memory right now. Moving right along to section 120, the overseas communications tax. I want to use an active recall prompt here. Don't wait for me. Guess the answer in your head. Who actually pays this 10% tax? Is it the telecom company providing the line? Is it the person receiving the call abroad? This is a classic board exam trap designed to see if you truly understand the mechanics of the law. Got your guess ready? Now, what's really interesting about this rule is the user pays. The telecom company is literally just acting as the middleman, the collector. The contextual anchor you need here is that this 10% tax is placed strictly on overseas calls or dispatch messages originating from the Philippines, and it is paid directly by the person using the service. The telecom just grabs that cash and remits it straight to the BIR. Oh, and a quick side note for your mental map, if it's a domestic call, that's subject to VAT, not this 10% overseas tax. But wait, not everyone actually pays this 10%. There are a few VIP exemptions you absolutely must know. Listen to this list: the Philippine government, embassies or consular offices representing foreign governments, international organizations operating under treaties, and news services. Now, for the news services, there's a big catch. It's only exempt if the message deals exclusively with the collection or dissemination of news. If a journalist uses that line to call their family abroad, yeah, that is still taxed. Let's move on and see how this builds. Bucket number 2, banks and finance, the gross receipts tax. This covers sections 121 and 122. Okay, we are entering the most mathematically complex chunk of this explainer. For banks and finance companies, the GRT rate on lending activities, we're talking interest, commissions, and discounts, drops significantly the longer the maturity period of the instrument. If the maturity period is 5 years or less, it's a 5% tax. But if they lock that instrument in for more than 5 years, the rate drops all the way down to just 1%. It's a very straightforward inverse relationship. Short-term equals high tax, long-term equals low tax. But here is the logic you really need to grasp for the LECPA. You cannot cheat the system. Enter the pre-termination rule. Let's say a bank issues a 6-year loan, totally expecting to pay that super low 1% GRT. But the borrower pays it off early, pre-terminating the loan at 3 years. The BIR is going to look at that and say, nope, the actual maturity was under 5 years. They will bump that 1% rate right back up to 5%, and the bank has to pay the difference based on the new actual shortened period. I want this single number to burn into your brain right now: 0%. In the world of Philippine taxation, 0 is basically a unicorn, which makes it an incredibly popular target for examiners. So what gets the magical 0% treatment under GRT? Dividends and equity shares in the net income of subsidiaries. Banks do not pay gross receipts tax on these dividends. When you're working through a problem and you see a bank earning dividend income, your brain should automatically retrieve 0% GRT. Seriously, it's a massive mental shortcut that will save you precious minutes during the exam. On the total opposite end of the spectrum, we have this number, 7%.
This is the absolute highest punitive rate in the GRT bracket. So you absolutely need to know exactly what gets hit with this heavy 7% rate. It applies to specific passive income streams and active trading gains. That means rentals of real or personal property, royalties, and net trading gains on foreign currency, debt securities, and derivatives. Basically, if a bank is making money from trading instruments or leasing out office space, boom, they get hit with the maximum 7% GRT.
All right, shifting gears. Open a brand new folder in your mental map for our third and final industry bucket, life and foreign insurance, sections 123 and 124. So the crucial point here is a massive structural divide in how the Philippines taxes insurance. Mixing these up is a guaranteed point deduction. Life insurance, which, by the way, also includes health and accident insurance, is subject to a 2% percentage tax on the gross premiums collected under Section 123. Non-life insurance, think fire, marine, or property insurance, is not subject to percentage tax. It is subject to VAT. Just repeat that to yourself. Life equals 2% percentage tax, non-life equals VAT. Let's quickly drill down into the strict exemptions for that 2% life insurance tax. Purely cooperative companies, completely exempt. If a premium is refunded within 6 months because a risk was rejected, it's exempt. Reinsurance premiums are also exempt, and here's the logic. The original issuing company already paid the tax, and the BIR doesn't double tax the same premium. And for variable contracts, the portion of the premium that exceeds the actual cost of the life insurance is exempt. Also keep in mind, if the insurance company earns investment income from investing these collected premiums, it doesn't get taxed again here. Okay, let's look at Section 124, which covers foreign insurance. If you insure property located in the Philippines with a foreign company that isn't actually authorized to transact business here, there's a specific tax implication. If you use an authorized Filipino agent to procure that policy, the tax is 4% of the total premiums collected. But if a property owner goes rogue and bypasses the local agent to deal directly with the foreign company, the law slaps them with a 1% penalty difference, making the tax 5% of the premiums paid. So, agent equals 4%, direct equals 5%. We made it to the last part. Section 4, LECPA Bullet Review Hacks. Time for razor-sharp focus. And this brilliantly illustrates how you can condense an entire section of the NIRC into a simple 4-digit mental PIN code. The bank GRT hack is 5107. 5% for short-term lending of 5 years or less, 1% for long-term lending, 0% for dividends, and 7% for trading gains, royalties, and rentals. 5107. Say it, write it down, lock it in. Mentally photograph this master cheat sheet right now. It contains absolutely guaranteed board exam points for sections 119 to 124. Let's run it back. Utilities, 2% or 3%. Comms, 10% on the user. Banks, the 5107 rule. Life insurance, 2%. Foreign insurance, 4% or 5%. If you can retrieve this exact summary in the exam room, you have officially conquered special percentage taxes. Before we wrap up, let me leave you with a final provocative thought to test your deep analytical understanding of the tax code. We know from our hack that net trading gains are taxed at 7%. But what about losses? If a bank realizes a massive net trading loss in 2024, can they carry it over to reduce their 7% GRT liability in 2025? Take a guess. The answer is absolutely not. Under the rules, a cumulative trading loss cannot be carried over to the next taxable year. It's literally use it or lose it within that specific year. Philippine tax law is strict, my friends. Keep reviewing, keep chunking this data, and you will absolutely crush the LECPA. Thanks for hanging out with me on this explainer, and keep that momentum going.